Hello, everyone. Welcome back for another Fratarcangeli Friday market update. It's good to see you all again this Friday morning after a pretty wild week. We are jumping right into the headline news on the Fed lowering interest rates by 25 basis points on Wednesday, but also indicating two more rate declines between now and the end of the year, which would be a total of 75 basis points, bringing us from 4.5% down to 4.25% as it sits today, with the anticipation of potentially going down below 4% to 3.75%. This is very important to many out there that are sitting on revolving debt. In other words, short-term interest rates going down will affect the floating interest rates that many have on their balance sheets for companies like car dealerships or individuals that have home equity lines of credit. This will reduce the interest charge instantaneous, which is going to be a big relief for many of those in the, say, industries of car dealerships, because of the cost of carry of inventory and floor plans will have a little bit of a relief with anticipating more. And what that could lead to is companies coming out and getting more inventory because of their costs going down. This is, I believe, a well-deserved and well-needed relief across the bow, and I'm very interested to see how things play out. We also saw the market hit new highs on Thursday. This is a multiple time new highs that we've seen across the board, but really definitive moves that we're seeing right now, and anticipating that the reduction in interest rates could lead to more opportunity for growth across the markets, as well as companies with relief. So a lot of things we're watching there. In addition to that, we're closing the books on Q2 earnings, and we're looking at a 12% earnings growth over last year, 2024, second quarter earnings to this year. That's a very pronounced increase. In anticipation for Q3 earnings, we're looking for approximately a 7.6% earnings growth. And if we've learned anything over the last several years, we've seen 81% of earning reports beat their estimate. So with the target of 7.6, it's going to be interesting to see if numbers come in a little bit higher. So very strong numbers across the board. We saw small and mid-cap sectors increase the most yesterday. So what we're seeing is a rotation into other areas of the market. Like, for example, growth has been very strong since April 7th. Value was much stronger earlier this year. We're starting to see a little bit of a rotation into more defensive stocks. And we're starting to see some backfilling in small and medium-sized companies' stock prices starting to rise. So we're seeing across the board and across sectors some strong movement in the market. That's a very good indicator for extended growth. And here we are in September with the September slump expected. And hey, it hasn't come. Matter of fact, we've hit new highs now multiple times this month, including yesterday. So maybe that pullback that is always out there will be pushed out to maybe the first part of next year or sometime between now and the end of the year. But I think we're seeing some deviation from the history that we've seen the last 4 and 5 years, with September and October being very slow months. Not quite the case this month. And some of that is built upon the anticipated interest rates, the strong earnings, and also data. We're starting to see some good numbers come out on the job numbers. We saw a 33% drop in unemployment numbers, and that's a good sign, considering we were hitting 4-year highs last month, and so a bit of a relief. And I think it's an indication that the data is starting to get more to the bullseye and getting us some information that we can work with. And we're hoping that continues, because that's so important for companies and the policy of our country to take action at an appropriate time if the data isn't exactly accurate. Now, just to bring you up to speed, last year the unemployment numbers were readjusted to the tune of 818,000 jobs, and that's a big miss. And so we're hoping that that changes. So those are some indicators of some strong cushion to the economy that we were concerned with the jobs number coming in very soft over the last several months. In addition to that, we saw manufacturing data climb to 22.3%, and that is another very clear sign of a bounce back in the economic activity, and maybe not quite so much of a pullback like we were thinking in the last couple months. Some good signs out there. And the reality of the situation is, as we look back over the last several decades and how the general index of the market, the S&P 500, has performed on an average rate of 11% per year, that basically means that your money, if it were invested over the last several decades, would have seen at a rate of return comparable to the S&P 500, you'd have seen your money double every 6 to 7 years. So as we go through all of this data and talk about interest rates and talk about where the economy is going and where unemployment is and where the manufacturing numbers are and all these different details that are relevant, the reality of the situation is, as Einstein said, the power of compounding is the eighth wonder of the world. Once you get your money into the market and let it work for you over time and not get caught up in the ebb and flows of the market volatility, the compounding is extremely powerful. So I want to make sure that we don't lose sight of that as I dissect the markets and the economy in the current information that we have available to us, and know that volatility is here to stay. And so we want to make sure that we don't let emotion, greed, and fear drive our decision making when it comes to investing, and we build portfolios aligned to our near-term as well as our long-term objectives, creating more cash and liquidity for that unforeseen, as well as those, call it fixed costs that we identify, and make sure that we put our long-term dollars, the money that we know we're not going to need for at least 3 to 5 years, into a well-diversified portfolio of different asset classes, including public markets, due to the fact that we know over time the market's going to compound. We're here at Fratarcangeli Wealth Management to guide, counsel, and answer any questions that you might have. All hands on deck. 40 employees of ours that we are extremely proud of. Many of you have dealt with, and myself as well. And I look forward to talking to you soon. I wish you the best weekend, and bye for now.